Financial Modeling, Topic 11, Calculating Default Adjusted Bond Returns. References for this material are Financial Modeling, 4th edition by Simon Benenga, chapters 23. There's also some Excel files that cover this material at my Google site listed below. So in this topic, we're going to understand bond expected returns, bond ratings, transition matrices, and recovery rates. We'll then calculate a two-period model to compute default adjusted bond return. We'll use matrix algebra to create an n-period transition matrix. And then we'll calculate an n-period model to compute default adjusted bond returns. Let's first start off by talking about the differences between YTM, or yield to maturity, and expected return. So when we talk about yield to maturity, we're talking about sometimes called the promised yield, because it's the discount rate that equates the market price of the bond to the present value of the contractual or promised cash flows, which is the coupon and principal payment. So in other words, the YTM is the annual non-default return. It's almost like a best case scenario. It's the rate of return if the bond does not go in default. Now, the bond's expected return is the discount rate that equates the market price to the present value of expected cash flows. In other words, default adjusted expected returns account for the chance of default and recovery of principal in default. And to complicate things further, default can happen any time throughout the life of the bond. Let's talk about credit ratings. The main credit rating agencies are Moody's, S&P, and Fitch's. And these ratings are simply assessing the probability of the bonds defaulting. Now you'll see in this schedule here that we have a red line drawn here, and all three of these rating agencies have two classes of bonds, and that is investment grade. So for S&P, that's through BBB-, and speculative grade, or in other words, known as junk bonds. So you see all the ratings going from AAA for S&P to single C and then D. Notice that D means it's currently in default for S&P and Fitch. Looking at some information from the S&P website, the Standard & Poor's website, some of the factors they use to come up with these ratings are they look at the country risk, the industry risk, and the competitive risk of the firm. They look at the cash flow and leverage. Then they look at the diversification within the firm, its capital structure, financial policy, liquidity, management and government, and comparable ratings analysis. And also whether or not that industry or firm has some government influence or group influence that could help it out and avoid default. All that information goes into the ratings. Here's an interesting study from Damodaran from NYU. He found that the interest coverage ratios for large manufacturing firms, small and riskier firms, and financial services firms. So one way of thinking about ratings, if you boil it all down to interest coverage ratios, which are your operating profit over your interest expense, firms, we're looking at smaller and riskier firms, firms that have a interest coverage ratio between 3 and 3.499. So they're generating 3 to 3.5 times their interest liabilities in cash flows, have a rating of S&P of about a BB. So it's a nice way of thinking about what it means to have a different rating. If I look at some historical default rates, this schedule up here shows the global corporate default rates by industry. And if we look at the lighter blue line, it's the 1981 to 2018 weighted averages. So you can see that some industries like utility and insurance have default rates less than 0.5% in any given year. And some industries like energy and leisure have default rates up to 3% in any given year. And we have some information here about firms with multiple downgrades or upgrades. When we talk about downgrades or upgrades, we're talking about switching from, say, a BBB to a BBB- and so on. And we have firms here, the number of firms that had 7 notches or greater downgrade. So you can see quite a few firms have multiple ratings changes in one given year. That's much higher than firms that have multiple upgrades. And then on the lower schedule, it's looking at average cumulative default rates by rating, and it's over a time horizon. So for example, if I'm looking at this green here, that's for triple C rated firms. There's about looks like a 25% chance that a triple C rated firm will default in 1 year. However, if you bought a triple C rated bond and say that's a 20-year bond, there's over a 50% chance that at the end of the 20th year it will have defaulted. And even if I look at, say, a high rated bond, say a double B, so this double B rated bond here, looks like the 1 year default rate looks like less than 1%. However, if you were to buy that double B bond and it's a 20-year bond, there's almost a 20% chance it will default within 20 years. So it's just more time for those bad things to happen to the industry, to the country, your financials, and your competitive position. One of the most important tools to use in bond analysis is a transition matrix. So here's a Moody's 1-year transition matrix using data from 1920 to 1996. And what it shows is in any given year, you have a rating at the beginning of the year and you have a rating at the end of the year. And if we look at this first number, 92.28%, that represents 92.28% of AAA rated firms remain AAA rated firms 1 year later. If we look at the 91.68%, 91.68% of AA firms remain a AA firm 1 year later. So it's this primary diagonal here. It's actually showing the probability that a firm will not change its rating in 1 year. Now, if I look again, let's look at this row here with AAAs. 6.43% of AAAs end the year at AA. So there's a 6.43% chance of a AAA rated firm being downgraded to AA within 1 year. And within 1 year, you could have multiple downgrades. So a AAA rated firm could be downgraded once, twice, three times to BAA, and 0.24% chance using historical data of AAA rated firms winding up at BAA. If we look at this B-rated bond, there's an 85% chance that a B-rated bond will not change its rating in 1 year. There's a 3.44% chance it'll get downgraded to a 3.44, and a B-rated bond, there's a 3.9% chance it will be in default within 1 year. So this is a credit rating transition matrix. This column here represents the current rating. This row represents the rating at the end of the period, and this is a 1 year transition matrix. Also, last thing I want to talk about is recovery rates in this section. If a bond goes in default, here's some data that shows on average the bond owner recovers about 41% of the principal. So let's think about a $100 million bond that goes in default. On average, the investor or the bondholder will get $41 million back. And this varies by industry. You can see that recovery rates for lodging over that period were very low, 27%. On the other hand, public utilities, they get back 70% of their money. And here's another interesting table here. It's looking at recovery rates by seniority and grade. And what this shows, if bonds have different seniority, so senior secured bonds on average recover 55% or 56% of their principal in default. And that depends whether it's an investment grade bond or non-investment grade bond, in other words, junk bond. And you can see senior unsecured about 48%, senior secured mid-30s, subordinated bonds have recoveries of about 32%, and discount and zero coupon bonds have recoveries of about 24%. And what you see is actually investment grade versus non-investment grade, the recovery rates don't change. The default rates are quite different. for investment grade versus speculative or non-investment grade, but the recovery rates are actually quite similar. So in this topic, we just tried to understand bond expected return versus YTM, bond ratings, transition matrices, and recovery rates.